All right. Well, we're going to go ahead and get started this morning. So happy Monday morning, everybody. Hope you're doing very well. We're going to start out with just a quick rate update of what's going on in interest rates. So I'm going to pull this down and kind of show you where we're at. It's been an interesting week. Last week, we had a pretty big scare as far as the inflation numbers that we all spoke of. But the markets kind of shrugged it off because the Feds, I don't know if you can see right here, this is where the bond market kind of took a nosedive. But the Feds, for the most part, said that they're going to open the discussions for tapering. So there's two things that happened. We had inflation numbers came out a lot hotter than expected, which we knew was going to happen. And that hurt the markets a little bit. And that's where this little first drop came. And then they started talking about tapering, which is essentially the government slowing down the buying of mortgage-backed securities. If they do that, that's going to limit the amount of people buying those mortgage-backed securities, and that will affect the overall value of these and drive interest rates higher. I'm going to circle back to 2013 when this happened before and kind of show you what happened there. But what we heard from them as the Fed minutes rolled out and into the next day is that they're opening the idea of it, but they haven't planned anything for that. So we saw an initial knee-jerk reaction where that dropped, and we had a huge 50 basis point drop right here in the bond market. And then we've kind of recouped that back because it's not going to be happening anytime soon. So that knee-jerk reaction caused us to lock in some interest rates right here because we didn't know what that future was going to be holding for rates. But as you can see, overall, we are pretty flat since April. If you draw a line, like the median, the average right here, going back, we went up and we went down, and we're kind of in this range. So we would consider this pretty flat, other than this anomaly where rates got pretty bad there for a second. We did recover and then come back down. So actually, we're in a pretty positive trend right now for interest rates. The one thing I want to make sure we're looking at right here is this little line right here. That's the 25-day moving average. We just pushed through that. So that's a ceiling of resistance. If we can stay above this, we'd have to pass through this Fibonacci level to get any better rates. So we have to hit through here to get above here to see rates get better. And that might be difficult to do, but that's the trend we're in. We're in this little upward trend right here where we had the low, we're kind of upward here. That's a good sign. So rates may improve this week. We really need some bad news with the markets in order for this to happen. So we'll keep an eye on the markets to kind of see what's going on. Now, what's happening in the markets is actually follows the trend of rates getting better. The numbers aren't as good as expected as far as the amount of people going back to work. We saw last week that the jobs report was horrible. And those filing for the first time for unemployment came in at 500,000, which was a lot higher than expected. And we're going to also have jobs numbers coming out this week as well. So we'll see how that trend goes. But bad news in the economy is actually really good news for interest rates. So on one hand, we want to have good news for the markets to like for our stocks and everything else. But at the same time, we want bad news because we want our mortgage rates to stay low. So it's kind of like, which one do you wish for? But it's going to be interesting to watch those employment figures come out. One thing that I want to make sure you guys know of is there is a new stimulus package that was passed. It's going to be starting July 15th. So like we talked about, our Fed chair loves spending money. There's no program she doesn't like spending money on. So now we're going to get more stimulus, and it's a child tax credit stimulus package. So the way it's going to work is on July 15th, for households that earn less than $75,000 a year that are single adult families that have children. So only one single family household or single adult household that has children, they'll get $300 per child per month until it runs out, which is, I believe, middle of April of 2022, where they're going to get another lump sum payment then too. So for families of one household or one employment or one individual, one adult, $75,000 or less, $300. And then for dual income families, mother or two income producers, it goes to $150,000, and that's for the married couples. And they will get $300 per child per month. So if you've got 4 kids, you could get $1,200 a month for the next year. Now, this is just more spending, which again is going to be paid for by us. It's not free money. So we'll have to see how this impact hits our overall inflation numbers, because it is feeding money into the industry. It's feeding money into the stock market. And some of the interesting numbers that played out on the last stimulus is only 27% of those funds used were actually spent. The remaining were invested in things like cryptocurrency, stock market, and those high risk stocks to try to get a quick return, kind of like gambling. So the money wasn't actually, not all of it, in fact, the majority of it wasn't put into spending. It was actually put into investment. So that's where you see like the run on the stock market and stuff like that happening. So we're gonna have to see where this extra income is going to be used. But anyone with children, we're gonna get a pretty big stimulus for the next year. So not sure how they're paying for it, but again, it's all going to be monetized by buying and selling bonds, which if there's too many bonds on the street, that's what leads to inflation and higher rates. So let's circle back to the bond tapering. So back in 2013, before that, they were buying mortgage-backed securities to kind of even out rates. And that was in the 2012 time where they started doing this at a mass amount. And that brought the rates down to levels that they've never been seen before. But then once they started tapering, we saw one of the largest rate spikes in decades. So the fact that the Fed announced that they'll be tapering again, which is buying less amount of mortgage-backed securities, buying less bonds, then that would indicate that there would be a rate spike once they did start doing that. So the hints that they are going to be doing that kind of puts not the fear of God into me, but it does give me a little bit of nervousness that whenever they will start that rates will spike, because it's done that in the past. So we'll see how they manage that. What we want to take away from this is, if you have any buyers that are looking to wait, don't do it. It's a terrible idea to wait. And here's why. When they do start this tapering, rates will be higher. And guess what? Appreciation is not going to slow down. So they're going to have higher rates, and they're going to have higher payment or higher purchase price on properties. So if anyone is waiting, just send them my way. Let me have just a conversation with them and go over the economics of it. And it really is a bad idea to wait. So that's kind of what's happening with rates. Another thing you guys are going to start seeing is the mortgage industry as a whole is seeing a pretty significant reduction in volume. So if you're a refi heavy mortgage company, most of that those refinances are down in a very high number. I would say down 50 to 60% year over year from last year. That means that all of those employees, all of those costs of hiring all those people to get those deals done, they're still on payroll, but they're doing half the volume. So you're going to see different mortgage companies adjust their rate sheets to compensate for that higher cost of keeping on those employees, and you may see layoffs. So you're going to see quite a big difference between different mortgage companies depending on their overhead and depending on the models that they have. So if you know companies that were doing a lot of refinances, you're going to see their rates be a little bit higher to offset the cost of overhead, and that's called margin compression. So you're going to start seeing that a lot of variances between mortgage companies in this next 6 months on rates. And that's one of the reasons why. Now, what are some of the things I wanted to go over right now? We all know that the supply of homes is low. So we want to make sure that we're setting ourselves up for success with the buyers that we have, because we need to really bat 1,000 when we're standing up to the batter's box and with our buyers. But interesting, I want to kind of share this with you. The buyer traffic index, which is a real estate index for buyers, that increased from 79 to 80 from March of 2021 to April. So that's very strong buyer sentiment. But on average, the seller sentiment went down to 50, which is actually very weak. So if you look at some of the numbers on, I'm going to share this real fast as well. The housing, if the existing home sales is actually slowed down quite a bit. So this big drop is the slowdown on the number of homes sold. However, that's only because of inventory. That has nothing to do with the percentage of homes sold versus that are listed. We all know that the volume is quite high because the average is 5 offers for every 1 home that's being sold right now with multiple offers. So it's an interesting statistic on the sale side, but as we know, the buyer side is quite strong. So just thought that was a really interesting statistic.
We're on another Zoom call, 11 to 11:30. How are you, Rich? Where are you at?
All right, I'm going to make sure people are muted if they're talking in the background. Now, on another note, let's go in to see, okay, so what can we do on the mortgage side to help you really move forward to do more volume in this year? We all know that self-employed borrowers had a really hard time in 2020 if they were in the food industry or others like that. So I'm going to go over some different programs that we have that are specialized to help self-employed individuals and kind of show you what options that are available out there, because there are quite a few programs that are now rolled out that are unique. And I want to go over that in detail. But let's talk about the non-contingent. What are some of the mortgage strategies that we can do right now for those people that are contingent in their minds? They're contingent on the sale of their house. So this is the move-up buyer. This would be someone like my family, where we want to get maybe a bigger home as our kids grow and take advantage of upgrading our homes, but we need the equity in our current house to do so. So one of the tricks, and when you're meeting with people that are looking to buy and they have a listing, part of your presentation should always be in this market, analyzing what the strategies are to make it non-contingent when you're doing that listing presentation or that listing appointment. Because if we can early on set them up for success by setting that equity position they have up as a tool to buy the next house, it's going to do a lot of wonderful things. So what we're talking about is getting a home equity line set up on that property that they're going to be selling for the down payment. Now, this would allow, I call it my hybrid bridge loan. So if you have a house for sale that has equity, but you want to buy another one, but you need that to buy the next house, get that equity out with a home equity line. You don't have to pay for it until you actually use it. Have that ready for the down payment on the next house. Then you can buy the house and hopefully qualify with both of the mortgages to be able to do a non-contingent purchase. So that's one thing I want to really focus on, because it is a huge tool to do that bridge for those people that have to sell their house in order to buy the new one. Let's set up that home equity line early on, get that ready, and then they can list their home after that and have that money set aside like a checkbook to write the down payment for that next house. Then they buy the other house, they close on it, they sell their house later, pay off that home equity line, and then they're back to the drawing board with just having that one mortgage. So a great tool to use in your listing appointments if you have somebody that needs to sell, but you want to eliminate that contingency. So that's what I call the bridge hybrid. I've also seen people do cash out refinances on their home. It acts the same. It's just a cash out refinance. This is more if they want to then rent out the property that they're going to be departing. So if somebody wants to buy a new home, but they want to use the equity from that home that they're living in now for that down payment, we can do a cash out refinance as a primary residence, put that money aside, and then start shopping for a home. And then they can rent that home out afterwards and then go use that cash out money to buy their new primary residence. So that's more of a situation where there's renting, where they want to rent that property out, but they still want to buy a new primary. We can pull the equity out, rent that property out, and then go buy a new one. And remember, you can use 75% of the rents received to offset that mortgage. So it's quite simple and easy to get approved when you do it in that strategy. Also, you can use 401k loans or gifts for that down payment as well, so that you don't have any contingencies. For those that have free and clear properties, we can do a loan that's very little down, like 5% down or 10% down, and then buy the house. And then once that house sells afterwards, they can just pay off the new mortgage. So very small down payment to buy the house. They're in the house, they've lived in it a little while. Finally, the other house sells. They could just pay off the mortgage because there's no prepayment penalties on mortgages nowadays. So that's another way of bridging the gap for those people that think they need to do it on a contingent status. Again, we're trying to eliminate all of the contingencies that we can. So here's some programs that we have that are going to really help the self-employed borrower. No ratio. So most of these programs will be between 35% down and 10% down. So obviously there's a big difference between all of them, between occupancy and loan size, but here's some neat programs. So no ratio basically means on the application, there is no income or employment listed at all. So there's no way of calculating a ratio or a debt to income ratio because income is not even on the application. The only thing we look at is assets, how long they've been self-employed, and credit score. Now, this program is very unique, and it really is, it's not a stated income, it's a no documentation loan for the most part. It's a zero income loan. We've closed a few of these. They are a little bit higher in interest rate, but they are a means to an end. They're a way to get them into a property now before rates do go up, and they can always refinance later if they're able to show income at a later date. So that's the no ratio program. It's a big program for self-employed individuals, but you need 3 years worth of self-employed history with that company in order to qualify for this program. Then there's the bank statement program. Very similar. There's no income really shown as far as W-2 or tax returns, but we use your income from the deposits on your bank statements. That's personal and business bank statements are used. And it can only, for the most part, used up to 50% of the business because there are expenses, but that's another means to an end. And it can be a great program for those people that write off everything, but they can absolutely show the income on bank statements. Asset depletion is for those people that have a lot of money, but zero income. So if they've got $3 million in the bank, but they have absolutely no income, asset depletion basically says, if you have $1 million, we'll give you $10,000 a month of income. And that's all we have to do is verify that funds are in your bank account. You don't have to move it. You don't have to do anything like that. Debt service ratio is a newer program. Basically, what this program does is it's mainly for investors. You can buy an investment property as long as, and this with no income documentation at all, as long as the mortgage is cheaper than the rent you receive. So let me rephrase that. If the rents are $5,000 a month that you're going to get on a long-term rent, this does not count for VRBO type properties. If you're $5,000 of rent and your mortgage is $4,500, that's the only stipulation needed to qualify for that program. Now, you do need 25% down, which most investment properties need, or more, depending on your credit scores. But it's a great program, no documentation program that is available. Another one is asset optimizer. This is very similar to the asset depletion program, but it gives you a lot more money to use towards qualifying, but the rates are a little bit more outrageous. They're about the 9 to 10%. It's basically a hard money loan. So that one is, if you need more income to qualify, you can step it up to this one. A little bit riskier because they give you a lot more income to qualify. We do offer non-warrantable condos. So if you have any non-warrantable condos that are listings that are coming up, let's go over these together. What options are available? Typically 20 to 25% down is a requirement, regardless of the occupancy. And usually non-warrantables are because one owner owns more, a high percentage, or there's litigation with the condo, or the amount of renters in the establishment is too high. So there are options for that. And I have those as well. So all of these are really dig into your past customers that may not have been able to buy in the past, that you may think this may help them get into a home, because it is another way to get buyers, just to kind of think back on all those people that maybe didn't qualify before. Now, foreign nationals, anyone that is not a US citizen that has external income with no income that is claimed on US tax returns, can do the foreign national program. So that's Canadians, anyone from Mexico, anyone from Europe, anyone from any other country that is not a citizen but wants to buy investment properties here, the foreign national program will work for them. Now, if we do see a spike in rates, I want to just put a tickler out there on the future program that I think is going to be really important. And that's what's called the seller buy down. So we always try to figure out ways of being creative if rates do go up. And if the markets switch a little bit and the pendulum swings and now we have more inventory than we have buyers, you're going to want to have your listing stand out. Now, this is foreign to what we're at right now, because right now everything's selling in seconds. So this is once homes start coming back to normal market and there's a lot more listings and they're sitting on the market for 30 and 45 days. This is something that you may want to utilize to make your property more attractive. I'm just putting this as a tickler just in case it comes down the road. You can offer, let's just say the interest rates go to 4.5, which I hope does not happen. But that did happen back in 2013. They went up a full percentage a full percentage in 1 month. And if that happens again, you could say, okay, my seller is willing to give you enough money to buy the rate down to 3%, even though rates are currently at 4.5, as part of the transaction if you buy this house. So the seller buy down is a seller credit to pay to buy down the rate for the buyer to make it more attractive for them to buy. So if we do see a rate spike, keep in mind that this is going to be a future program that you may want to incorporate into your listing presentations to make that property a little bit more attractive.
So
and you can
Sean,
price this. Yes.
Are those would that be a temporary buy down like the old 3-2-1s?
Nope, that's permanent.
Permanent, okay.
Permanent buy down. Yep. Good question. Good question. Now here's some of the guidelines. The bank statement mortgage program. Here's the loan to values. Bank statement mortgage program that we have, 640 credit score is the minimum, which is low, and up to 90% of the purchase price. So that's 10% down with bank statements. 1099 income, there's that same kind of program using their 1099. And then you go through all of these programs. Look at these, I mean, we have a lot here. Investor cash flow, 20% down, just using the cash flow of the property. Just missed conventional financing, 640 on jumbo, 10% down. So there's a lot of programs we have for those loans that just miss, or let's just say they get denied with a bank and they don't have all of these programs. We've got a slew of all of these non-qualified mortgages or non-QM mortgages to place them into if it doesn't work. So just keep in mind, all of these little tools right here, all of these programs are all set up to help you guys do more business on those people that maybe you couldn't get qualified before. And some of them, here's a piggyback home equity line. We do that all the time. Some of them are really aggressive. This no ratio we were talking about, that's literally no employment information at all in the application. You need a 680 credit score for that, and there's tiers, but the down payment is 30%. So a lot of new programs that are being rolled out, they are all portfolio in nature. So they are all private money, unique programs to really help you guys with those scratch and dent type buyers that maybe couldn't get qualified before, let's pull them out of the drawer. Let's see if we can find them a home, and just additional programs we have to help you guys do more volume as the inventories continue to dwindle. And there's a lot of them, guys. This one goes down to 600 credit score right here. No employment information or income required. 3 months of bank statements, loans to 1.5 million. Now, these aren't pretty rates. They're probably in between the 6 and 8%, depending on their actual credit scores, but a lot of flexibility. And again, it's because it's private money and they know real estate values are going to stay up. So they're okay to make that risky play and fund and do these loans. So I'm going to stop the share my screen for now. There's a lot we went over. Yes, I'll get a copy of that spreadsheet. I'll forward that over to you guys so you can kind of see that breakdown of those different programs. A lot of new programs out there. So it's really exciting to see the markets open up on that, because I don't know if you remember, but during COVID, almost all of those went away. They have no clue on the private side what was going to happen with the mortgage industry. And we all know what happened. Real estate boomed, values went up, inventory went down, and real estate is actually a very sound investment now. So now they're all kind of getting back into the markets. So that's an overview. I kind of spoke for quite a while there. Any questions on any of the different programs or any of that hybrid bridge loan that I went over? Any circumstances that you guys have that may become handy, let me know. And other than that, I think we're in a good position right now in the short term for interest rates. When I say short term, I think the next month or two. Now, once the new inflation numbers come out, which is going to be mid-June, we may see a blip higher in rates just because of that, because again, we're going to add in an inflation amount that is a lot higher than what we had 12 months ago. We're going to remove a negative number and include a positive inflation number. So the overall inflation number, you will see it on the news. It's going to show inflation higher, but the markets don't seem to care right now. It's really interesting. So we're going to really keep our eye on that. And but once tapering starts, that will be a big clue. But I think that's 6 months out minimum. So we'll see what the inflation does as far as goods and the cost of homes. That will continue to put pressure on prices going upward. And if you guys have anybody that is a buyer that is thinking about waiting, just tell them to call me and we'll have a real candid conversation, because it's not going to look good a year from now if they were to wait. They're going to miss out on 6 to 10% appreciation and interest rates being low. So any questions for you guys or from you guys?
Hey, Sean, I have a client whose escrow fell out. There was, you guys are the lender. So it's kind of an interesting situation. I'd love to speak with you about it. So
sure.
I don't know if you have a chance to call or something whenever you do. Call Valerie.
Yeah, absolutely.
Thanks.
You got it. I'll stay on the line or on the call for the next 10 or so minutes. So if you guys have any specific or unique circumstances that you want to go over, I'd be happy to go over those with you. And it's Monday, so go out there and knock them dead. Have a great week. And if you need anything, I'm always here.
Thanks, Sean.
Thanks,
you
Sean.
got it. Enjoy your day.
Thank you, Sean.
My pleasure.
Hey, I wanted to ask you again. I think we talked about this last week, the disclaimer deeds, that you could only use them on a conventional loan or private money. Is that correct? You can't use a disclaimer deed. Let's say one spouse has a bad credit score or something like that on an FHA.
Got it. Okay, so what you're talking about is doing the loan in one person's name if they're married and excluding the spouse.
Exactly.
All government insured loans, so VA and FHA, require that if a married couple or if a married person is applying for a loan, we have to count the debts of both spouses or both married couples in the debt to income ratios. Now, they're not on a loan, And that can be used, the disclaimer deed can be used, but the debts of that spouse must be counted against in the overall debt to income ratios for that one specific person that's qualifying. So if the wife has a car in just her name, we have to count that against him as a debt that he has to carry without her income.
Got it. Okay.
So all of the debts for the married unit have to be counted against that one person if you're going to be doing that. Does that make sense? But you can use the disclaimer deed. Absolutely. You can use that.
Thanks for clearing that up.
You got it. All right, so I'm going to get that spreadsheet and I'm going to get that overview of my notes sent out to you with the update and along with a link to this as well. So perfect. I'll stay on here for a little while as you guys have any questions that you might potentially have.
Thanks a lot for all this information. These are wonderful, these weekly meetings with you.
Yeah, you got it, Michael.
I'll talk to you later.
Yep. Enjoy your week. And I'll be here when you need me.